Hey everybody, it's Mr. Wagstaff. Cool stuff to talk about today. So today we're starting a new unit. This is Economic and Personal Finance, Unit 7. This is on credit and debt. So, about said debit. Credit and debt. So today we're going to specifically start talking about different types of credit. Then as we progress in this unit, we're going to talk about debt, some money management skills, and then at the end, we're going to talk about just some general financial literacy, some other additional things as we get closer to the end of this course that get put in here in one of the later lessons in this unit. But cool stuff to talk about today. Let's get after it. So this unit is all about credit, what it is, how it's measured, how you get it, which is what we're going to talk about a lot today, and how to be responsible with it. Because, kind of as this picture shows, debt, while it is very often a very necessary part of life, especially for really large purchases like cars and houses, there is plenty of people willing to give you credit. And we're going to talk about those people today. They're not necessarily trying to give you money because they want to be your friend. They want to make money off of you. So they give you money so you have to give it back plus extra, which is called interest. So they're not necessarily looking out for your best interest. So if you keep saying, hey, who wants to give me money? People will continuously give you money. That's credit. But you have to pay it back. And the struggle to pay it back can be overwhelming if you're not smart with what money you're taking, when you're taking it, and living within your means. So let's just go ahead and get into it today. Today we're going to specifically start talking about credit and different ways of getting credit. Before we even do that, we need to talk about the two main types of credit, all right? So credit is literally somebody loaning you money, all right? And if they're willing to loan you money, all right, that you have to pay back. It's not a gift. Credit, people loan you money, you have to pay it back. So there's two types. There is closed-end credit and open-end credit. Now, those seem like really technical terms, but I think you're going to find out as we talk about them here in a second that they make sense. All right, so let's start with what is closed-end credit. All right, a lot of times closed-end credit is actually referred to as a closed-end loan because a closed-end loan, all right, is a type of credit in which when you get the money, there is a clear set amount of time in which you have to pay it back. All right, it's not expected to be paid back immediately. It's not expected to be paid back that month. It's over a long period of time. All right, there's usually a whole bunch of paperwork you had to do in advance for it, and you have years to pay it back. And a lot of times these have lower interest rates since it's kind of a fixed thing. Everything's locked in, and there's an end to this loan. All right. Also, you're not taking out more money. It's closed, which means they give you a certain amount of money to start with, and they don't give you any more. And then there's an end date. All right, so it's a closed-end credit. The most common examples of this is like a home loan. Hey, I need $150,000 to buy a starter home. The bank gives you $150,000. That's a closed-end loan. If you can't go back and say, oh, my bad, make it $175,000. That doesn't work that way. You'd have to take out like a whole separate loan to get that. So closed-end loans are common for a home loan where it is a set amount of money and then you have a very clear monthly payment that you have to pay back over time. The next most common version of a closed-end is going to be a car loan. Houses, cars, these are closed-end loans. They give you a very specific lump sum for exactly what you're trying to buy and then you pay it back over time. This is extremely common. You're going to be, if you purchase cars or houses in your life, you are going to be in the 0.00001% of people if you can do that without having to take out a loan of some sort, and it's almost always going to be a closed-end loan. So, closed-end loans, very common, very straightforward. While you can get underwater very easily on closed-end loans, the biggest issues usually is open-end credit, all right? Open-end means you can keep taking out pretty much as you want. You might have a limit like per month, but you can keep taking out as much as you want based on the individual needs at the time. The most common version of an open-end loan is going to be credit cards. So credit cards is you might have a limit per month, but you can just keep spending that credit card when you need it. There's no set amount that you have to take from them, and you take your money as you need it. So that's open-end, that there's not a set end date. You can keep paying on it as long as you want. Interest will keep going up, but there's no like end date. And if you like aren't paying the full amount, it's not the same as a closed-end loan where they can come like take your house and things like that. So credit cards are the most common form of an open-end credit, whereas like a home loan is the most common form of a closed-end loan. So the question here is, explain the difference in open-end credit and closed-end credit and what each would be used for. So pause me, answer that completely, and we're moving on. All right, so let's start talking about sources of credit. And this is either open-end loan or closed-end loans, all right? So let's start talking about banks and credit unions. So even though they're two separate vocabulary words, to kind of understand the differences in them, you need to understand that banks and credit unions, for the most part here, are the same thing, all right? So there's sources of credit, all right, that we're going to talk about today. We're talking about some credit cards, banks and credit unions we're talking about now, some online lenders, pawnbrokers, private lenders, and some other sources of consumer credit, but mainly those top ones here. So let's get back to banks and credit unions. So I've talked about when you're financial planning, when you're splitting hairs here on how to manage your money, that there's differences in banks and credit unions, and there are differences in banks and credit unions. Credit unions are usually only eligible to a certain amount of certain people, like if you're a teacher or a state employee, or if you've been in the military, and if you're like, oh, I haven't been any of those things. Well, do you have like an aunt that was like a teacher for a couple years and happens to be a member of the state employees credit union? If so, you just show up and be like, I have an aunt that's an employee here. And they're like, oh, well, welcome. Come on in. So they basically just like to have like a tree connection of people that are associated with their membership. And not just anybody can join, but honestly, you can probably find a way to get into most credit unions if you have an extended family, that is. Banks, they're open to anybody. For the purpose of this, we're going to pretty much talk about them as the same. Now, I want to talk about interest rates. I'm going to talk about that a lot today. So they give you credit. You need to take out money to get a car, all right? It's probably going to be a closed-end loan. Here's the interest rates, and I grabbed this, and they seem really different, all right? At a credit union, if you want to get a new car loan, you get 2.98% interest, all right? That's almost 3%, all right? And that is thank you money per year until you pay back the loan. Banks, 4.77%. Well, that's so much higher than that 3%. Well, we're going to start talking about some wild interest rates that happen in other things, all right? Banks and credit unions, as far as credit goes, have by far the best interest rates. That's the lowest number you're going to see today, like by far. The reason that is banks and credit unions can offer the absolute lowest possible interest rates for a variety of reasons. Like we're talking about mortgages, all right? Same thing with home loans. There is so much red tape, meaning paperwork you have to fill out, things you have to qualify for in order to get these loans. They check your background, your employment history. They have to know who you are. And a lot of times when they're giving you these large amounts of closed-end loans, like for a mortgage, they're actually buying the house. Like when you take a mortgage out to buy a house, actually the bank is buying it. You're just allowed to live there and pay the bank until you pay them back, and then you own the house. Could be over 30 years. So technically the bank owns the house. Because if you don't pay it, the bank takes the house from you, kicks you out. You don't get any of the money you've already paid back, and the bank can take it from you. So there's all these like collateral, there's background checks, your credit score, which we're going to talk about tomorrow, is a huge part of all this. Having a credit check, have you paid your loans in the past? The reason they can offer such low rates is, number one, they have the capital, they have the money there. Number two, there is a whole bunch of hoops you have to jump through in order to get these loans because they want to make sure that you're capable of paying it back. They do very much due diligence to make sure when you get a loan from a bank or a credit union, you can pay it back. So they have these very strict eligibility requirements for their loans because they want to make sure they're loaning it to people who can pay it back. When everybody's paying their loans back, they're not really in any fear of losing money, so they can overall have lower interest rates. So the question here is, why do you think that banks and credit unions, the most traditional of credit lenders, have such strict eligibility requirements? So pause me, answer that completely. We're moving on. All right, let's talk about some other ways of getting, you need money and you don't want to go to a bank, how else can you get it? There's a new one that's out, and this has skyrocketed in the last 20 some years, in large part because of the advent of the internet. So you can just go online. This is a company here, Money Mutual. You can go online and be like, hey, I need money now. I need $5,000 for whatever. Like my car broke down and I need money to fix it. You can go online, clickety-click, and very shortly they will, boom, you got $5,000 in your bank account to go fix it. A whole lot easier than going to a bank or a credit union. That's awesome. Now what's the catch? Well, the catch almost always when we're talking about credit is going to be the interest rate. Online lenders are wildly different. Here near the bottom, online lender, keep in mind, we were like, oh, it's so much different between 3% and 4.7% with the credit unions and the banks. The lowest you're ever going to see in an online lender is 9%, up to 99% interest. That is wild, all right? So usually the easier it is to get credit, all right, the higher the interest rate because whoever's loaning the money is taking a risk that you might not pay it back. While there's, again, we'll talk about credit scores and stuff tomorrow, there's definitely negatives on you if you don't pay it back. They also don't get their money if you don't pay it back. So these interest rates are phenomenally high. The more risky it is for people to loan and the easier it is to take the money in. So online lending has really become more popular within the advent of the internet really since 2000. So this has become much more common because it's easy to hop on and get the money, but the interest rates are much higher than at a bank. The most common way of credit, and this is an open-end credit source, is credit cards. So the way credit cards work, all right, these are super common. Credit cards, when we just take a single month, we'll say it's June, all right? You take a credit card and you go to the grocery store and you have $130 of groceries. You swipe your credit card. That money doesn't come out of your checking account. That money comes out of, say it's a Visa or a MasterCard or a Discovery or a Discover card. If whatever company your credit card is from, it's coming out of their bank account, all right? At the end of the month, all right, and you swiped it buying groceries or whatever, say you spent $800 of their money throughout the month. All right, you're going to get a bill at the end of the month for $800 because that's what you used of their money. You then have to pay that back at the end of the month. If you pay it back at the end of the month, you're good. There's not even an interest rate on this. You're good. All right. Not only that, there's actually benefits. This helps your credit grow. Everybody knows you're good with people want to loan you money because, hey, this person will take money, they'll pay it back. Hooray. But credit cards make a ton of money because they don't really want you to pay it back on time. So here's a collection of different types of credit cards that are all sponsored by Visa, MasterCard, and Discover. Notice this, the lowest rate that you're going to find on any of these, I think what business credit cards, 13%. That's the lowest you can find. That's the lowest interest rate. High rates are 20%. Then the late penalty rate is 30%. 30% is what you have to pay if you're late on your payments. Credit cards are very dangerous to get yourself into a cycle of debt, but there are definitely some benefits to credit cards if you pay them off on time. They help your credit, and we'll talk some about that more tomorrow, but it's a little bit like playing with fire here. So explain what online lenders offer that typical banks or credit unions do not, and what the trade-off is for it. To clarify, the ease of access. You can get money like almost that day with these online lenders, but the payoff is the interest rate is going to be very, very high on it. All right, so pause me, answer that completely. We're moving on. Now we're going to talk about two different types of credit sources. These are basically if you're in a panic mode and you desperately need money fast. I am not your financial advisor. I don't know in a lot of ways in which if you had planned ahead, either one of these are a great idea, but these are ways of getting money if you desperately need it in a short amount of time. First one, all right, is going to be called payday loan. So a payday loan is a loan to get you to payday. That's kind of where the name comes from. So if it's 2 weeks from your next paycheck and you are out of money and you got to have groceries or you're going to like starve to death in the next 2 weeks and you have no money, you can go get a payday loan and they will give you, like here on this sign, $50 to $500. All right. And the goal is to hold you over until you get your paycheck, then you pay it back. However, if you were already past your budget originally on your paycheck, the chances of being able to pay it back and then survive the whole next month without having to take out another payday loan is going to be difficult. So payday loans, and typically all you have to do is show up and explain to them you're employed, give them a copy of your last paycheck and let them know like when you're getting paid. They may call your employer, see if you have a job and you're actually getting a paycheck. That's about it. There's usually no credit check or anything like that. It's very easy to get. People very quickly who take these payday loans, because it's super easy money, you can get your money in like 15 minutes, get saddled with these debts because keep in mind, and I've kind of guided you to be critical of credit unions versus banks at 4.7% and 3%. How about 400%? That's if you take a year to pay it back, all right? Because they're expecting you to pay it back in like 2 weeks, all right? So if you take out a $500 loan, all right, you may turn around and have to pay them back $575 or $580, maybe $600 a couple weeks later because it was an emergency fund. If you stretch that out over the course of the year, it's thousands of dollars that you'll have to pay back for a $500 loan. 400% interest rate. That's stretching something that's only supposed to be 2 weeks over a year though, so not exactly apples to apples. But payday loans, it's easy money, wildly high interest rate. So the easier the money is to come by, usually the higher the interest rates. Here's another one, pawnbrokers, all right? Pawnbrokers loan money. You probably have seen pawn shops. If you've ever gone into a pawn shop before, it looks like this. They usually have guns, all right? It's very common in pawn shops. Guitars. This is a random picture I found on the internet of but all pawn shops tend to look very similar to this. And there's all types of random used things in there that are usually relatively high quality. So what a pawnbroker is and how they make money is, say you are in that same situation, you have to have $500 to make it until the next week, all right? So you can go to a payday loan or you can go to a pawn shop. Now, you have to take in collateral, all right, things to pawn off. So you're taking, let's say, you know what, you have a really fancy guitar that is worth, $2,000, all right, because that's here in the picture. You take your $2,000 guitar in there and say, hey, I want to pawn this. And they're like, all right, cool. Here's what we're going to do. I'll give you that $500, all right? You're going to give me that guitar, all right? I'm going to hold it here for 3 months. 3 months, all right? It just sits in the back in the safe. It's there for 3 months, all right? Nobody sees it. Doesn't go up here on the wall. After 3 months, you have to have paid me back that $500 plus the interest. And so here's the interest rate. It's usually about 13% per month. So if you borrowed $100 after 3 months and you paid it all back, it would be a total of $144 on a $100 loan. That's still a pretty big percentage, but not 400%. If you pay that back, all right, in 3 months, you go back, you get your guitar back. The guitar is collateral. Because you have something of value, you have loaned them while you're paying back your loan, their interest rates are lower here, so 13%. Again, This is panic money. This is, I don't have another option here, all right? So pawn shops, and it's very quick. There's no credit checks, usually anything like that. So if you ever go in a pawn shop and you see all this stuff around, it's all for sale. Because what that pawn shop's going to do is if you just don't make your payments, the pawn shop's not coming after you. Cool. After 3 months, that's the contract that you signed, that guitar that you paid $2,000 for is theirs. And they'll turn around, no, it's used. It's a used guitar. And they're just trying to make their money back. So they sell it for $1,000, all right? Now keep in mind, they only loaned you $500. So it's not a good trade-off here. They make their money. So all the stuff in the store at a pawn shop is stuff that people have come and pawned off, and then they don't come back and get it, and they don't pay off their loans, and the pawn shop sells it, and that's how they make a profit. So pawn shops, they buy stuff from people and then will sell it at a profit. If you pawn it, you usually get way less than what they're going to sell it for, and they will hold it for 3 months for you. And then after 3 months, if you pay it back in 3 months, you get your stuff back. If you don't pay it back, they sell it. So pawn shops is a source of credit, but again, payday loans and pawn shops, these are absolute panic mode ways of getting money in desperate need. And a lot of times these are very short term, that you're just trying to get enough money to survive until the next payday. So explain what the purpose is of pawnbrokers having collateral. And so like in our situation, the collateral is the guitar and how that process works. So explain how pawnbrokers work and how pawn shops work. So pause me, answer that completely. We're moving on. All right, let's talk about something, and it is not new. Peer-to-peer lending is not new, all right? I need to get that out of my brain because I keep getting ready to present it like it's new. The format of it is new. Peer-to-peer lending, to simplify this, all right, is literally somebody you don't know loans you money and you pay them back, all right? But you're never actually going to meet this person. You're never actually going to know what their name is or anything like that, because there's going to be a platform that is a go-between, all right? So while this has been around for a long time, present day, there's apps that you can go sign up for if you want to be an investor and you're like, hey, I'm going to go on this app, and there's a ton of them, and you can kind of, like, whether it's real estate, student loans, cash advance, there's all types of different types of companies for different ones. All right. And like you see, Lending Club is one of the more common ones here. They do kind of all of this. So you download this app on your phone. If you have money and you want to loan it to somebody, and you say, all right, who here needs money for, they need to buy a house because you're super rich. People in there will show up and ask for money from you, and you can give them money. All right. The interest rate here is determined by the app, by the platform. All right. Like Lending Club. All right. We'll keep using them as an example. They're one of the most common ones. And the borrower has to then pay back the app, who gets a cut of the interest as they're paying you back as well. So this is peer-to-peer rate. So it's not super easy to explain exactly how it works universally, all right, as far as interest rates, how the other one does. Because the different companies like LendingTree and these other ones who basically connect individuals with people with other individuals, and they're just a go-between, kind of cuts the bank out as much as possible, all right? So they do check your credit score. That is a big part of this, is whether or not they're willing to lend you money, or what the interest rate will be is based on your credit score, which is something we haven't really talked about yet. The next lesson, we're going to talk very extensively about this arbitrary number called your credit score, which is going to rule your life more than you can possibly imagine. And it's this fictional number that like floats above your head. Anyway, so the interest rate, while it's dictated by, we'll say LendingTree, even though you saw there's a ton of different options, the interest rate is usually close to a credit card rate. So credit card rate, you see 13, 14 here, you're like, okay, this is a fair price. It's not 400%. Credit unions and banks, 3%, 4.7%. All right. Let's keep that in mind, that interest rates are not the same, anything close to what banks and credit unions are. However, the longer the rate of the term of the loan, if it's a closed-end loan, you're going to have a lower interest rate because it's clear payments have to be made. Open-end credit is going to have higher interest rates. So the type of loan, the length of loan, what your credit score is, what your credit worthiness is, all that stuff here in peer-to-peer is going to affect what your interest rate is, similar to banks, but it's much easier to do, and it's individual people that are connecting with other individual people through this app that kind of keeps everybody neutral and from like really contacting each other. And the peer-to-peer type credit source is becoming more common because it is more easily accessible. Online lending, which is you're getting it like directly from a bank, that is still, whenever you see in this unit talk about something that's become more common recently, online lending, because the internet didn't used to exist. Peer-to-peer lending also is becoming more common, but it has existed for a much longer time. It's just kind of in a different format now with the internet. So the question here is, how do peer-to-peer lending platforms determine the interest rate charged to borrowers? So we just talked about that. So pause me if you need to answer that completely. That's what I got for you guys today. See y'all tomorrow.